All right, guys, how's it going? Another Trade Genius podcast with Bob and Phil here. There's been some chatter about is it safe to go back into the market? There was some positive housing data that exceeded expectations on new housing starts. But if you're looking to buy or maybe even sell property, you're not going to want to miss this video because we got some really important data. You might be surprised at what we find. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey, Bob. So you had shot me a chart of the kind of what's going on the metro, the city, big city housing pricing year over year. And it was pretty wild as far as just how things have rolled over here.
Yeah, so look at these charts. There's not a single divergence across all the cities in the United States, and this is all basically the reset because of the change in the interest rates and the affordability of the homes. And what really caught my eye is look at the West Coast.
Yeah,
it is an absolute disaster, and this is ground zero for the last time we had a collapse in housing. We had the Phoenix market and we had the Las Vegas markets implode first. But this time, we're not getting help from the tech sector or China. And you're starting to see LA and San Francisco and Portland and Seattle. They're all imploding as well. And it's not going to take long before you start seeing some of the other blue cities go down to, like Miami's holding up okay, but it's falling too. And so I think at some point, this cascade is going to continue. But these next charts I'm going to show you is going to say, hold my beer. So at the same time, you can't afford a home. Prices are still falling. Still, they're still jacking rents in New York. This is absolutely insane. Even though housing prices are falling, rents are still going up. And the most egregious is in New York. It's just, I just can't imagine, people willing to pay this kind of money for a rent. I mean, I was told that you need $161,000 a year in family income to afford rent. They take 40% of your income, in New York for housing. And it's insane. And here's the thing, though, and we're going to get to the CPE number here in a second. 40% of the CPE or the PCE is rent. So, but this is the funny one. This next chart. You did this one. You went out to Google and started saying, hey, what is the breakout in terms of the search results? And can I sell my house if it's in foreclosure? Phoenix, Arlington, Milwaukee, it's like everywhere, Can I get a home equity loan with no credit check? Sure, why not? And so, yeah, I thought this was pretty funny. This is the kind of stuff we started seeing in 2007 and 2008 as well.
Yeah, I think you can't ignore Google Trends. I mean, we referenced them for crypto, right? In crypto interest, and it's pretty reliable. So I think you're starting to see, and unfortunately it's very similar to '08, I think, and you're starting to see people getting upside down and left footed on their situation. And I think that segues into people, the argument we're running into, right, Bob, is like, well, people are in their homes, they're at 2-3% mortgage rates, no need to sell, they're fine. Okay, but people forget the size of the Airbnb market, and those aren't primary residents mostly. They're second, third, fourth, maybe fifth properties. Some of these guys are serial Airbnbers. And when that market starts to fall off, things get real interesting. And that's what this next chart shows us. These numbers are wild, Bob.
Yeah. And so as I explained in our trading room today, it's it's not your primary resident mortgage that's going to get people. And just like in 2007, 2008, it was the home equity line of credits, Phil. And a lot of these people bought into the notion of take money out of your home, use it as a piggy bank, and go ahead and buy an Airbnb property and let that cash flow for you. And people did it multiple times. They basically they acted like they're almost like a bank doing a Ponzi, right? And so it only works if you're getting revenue in the door. And here's the Airbnb revenue drop that we're seeing here in May and June. And we're seeing ads all over the place about go vacation with Vacasa, with Airbnb, VRBO, be all you can be, and these revenues are collapsing, Phil. And when they collapse, people aren't going to be able to pay those mortgages off. Right. And here's the thing. So they got it with the cash flow. They down payment it with the home equity line of credit. And if they lose this property, they basically now have a massive loan on their primary residence that is subject in part to the higher interest rates that are climbing up. And if prices keep falling, and this would happen in 2007, 2008 as well, is that they'll start cutting these lines of credit.
Right.
Off of people if you have unused lines. And then next thing you know, people are just going to be giving these properties back. And this is a mess because your primary residence in a lot of ways is by the real estate itself. Some of these second mortgages out there, you have full responsibility. It's not as secured by real estate loans, so the property itself. So it can become problematic. Like I was telling people, stock market, you can get a tsunami and it's done. With the real estate market, it's a bit like you seeing a hurricane showing up, and it's just getting bigger and bigger as it slowly comes your way, and you can't avoid it and you can't get away from it, and it's not fast. And I think that's what's going to happen here.
Yeah, and I had some friends here in Hawaii that had gotten into the whole HELOC thing and leveraging that as collateral and getting another property and having maybe one or two other properties other than the primary. And then when the market collapsed, not only did they have to let go of those other properties, which they were trying to, this is before Airbnb, they were just, renting them out for income, but they also ended up losing their primary. And that's how, when these folks that are in primaries that are primary residences that are at low interest rates, the investment in these other properties unwinding is what can cause them to also be unwound out of their primary residence if they don't have the means, or they're taking losses that they weren't expecting. Because then you get into that situation, right, where you start chasing the market down. It's like all of a sudden now you got to get out of these properties. If you end up selling them upside down, all of a sudden now you might need to be looking at your own property to liquidate because you got to come up with money to pay off these upside down loans. So it can all unwind, even though it seems like, no, there's no reason for all these property owners at low mortgage rates. I think people underestimate the size of the Airbnb market and how much speculation was going on in there, because I do think it's very significant. So then you think, okay, well, but isn't the economy going to be growing and doing better? And it would seem, if you look at the AI market, it seems like everything's rosy. However, the AI market is a very small sector that's been driving a lot of what we've been seeing and all this bullishness. But if we transition over to what the actual leading indicators of the economy are, Bob, and as we've been trying to tell people, we're at a significant problem area here on these. And this next chart is the Conference Board leading index month over month, which is a basket of various indicators, consumption, cost of goods, things like that. And they come up with this data point. And bull markets don't start off when you're in the negative territory on this.
Yeah. So, we're seeing it in the packaging market, and we've shown you container markets. We also have, contacts in the disposable packaging markets too. And they're also seeing headwinds as well. So it's not just the cardboard and the packaging, it's the trucking, it's the consumables. All this stuff is taking a hit. Look at UPS and FedEx. Also took a hit. So all these things are telling us that the consumer is starting to fade here, and they just can't keep hiding it. The data will catch up with reality here. And in a lot of cases, we just know, incomes are down in tech, layoffs are happening in packaging, layoffs are happening in trucking. Truckers won't take the loads because they can't make any money. And so it'll just keep reverbing throughout the economy. And eventually, it's going to go right up. Real estate's already dead. car industry, look at the used car markets are coming down too. So it's just everywhere. And so at some point, all this stuff just goes from sagging to collapsing.
Yeah, if you take another look at the way that this data is rolling over, another way to look at this is the leading index, you look at the 6 month over 6 month rate of change, and you do that because you get a little quicker response versus year over year. But you'll notice where we are, minus 8.7 on the leading index. Anytime, guys, we come down from positive territory down to this level, every single time, 100% accuracy, it's a recession. So, and this goes back, into the 60s. So, this is why we think that everything that we've been talking about on the second half of the year, right, is going to come true. And because otherwise you're saying that all of this data all of a sudden doesn't matter. But I don't see any reason for that to be the case at this point. I think that, and also too, if you guys think about how badly the '08 market did end up falling, in between the high and the low, there were several 30-40% bounces, which got everybody thinking that the worst was over. But the underlying indicators or the underlying technical data in the economy were very similar to what we're seeing here. They were continuing to deteriorate. So as Bob said, sooner or later, the market catches up with reality, and then everybody's wondering, when's the bottom? So it's enjoy the bounces, but you have to be very nimble in this market. And overall, if you're sitting in a long-term short position, I think you're going to get paid ultimately. But certainly a two-way market. You just can't get caught up in the fact that, we're off to a new bull market when all these data points are suggesting otherwise.
Look, if you're listening to us because of the stock market already rolled off. It didn't make a new high with this last push. And so that second high is the one that says the return to normal high. And as that one fails, that's the big move down. This is the bigger and the longer move down. If you're listening to us because you want information on the economy, it's just slowly bleeding out. Just remember, Janet Yellen's trying to paper over a recession with increasing money supply by 5%. Jerome Powell is trying to take it away by increasing interest rates. And so unless you're netting 5% more out of your budget in the next 12 months, you're part of the recession crowd. That means, your cost of living. It means that, did you have a rent increase? Did you have your mortgage increase? Did your net pay go up, higher than your cost of living gone up higher? Then you're part of that problem, and you have no choice either to borrow more money, which you can't anymore, or you're going to have to retrench. And what Phil just threw up on the screen here now is the year over PCE forecast. And the consensus is still higher. Morgan Stanley feels that we're going to be at 5.3%, in 2024 on the Fed funds rate, because that's where they think they'll go to kill the PCE. So that's another 1 or 2 quarter point raises, Phil. Yep. And then I think it kills the beast, and then everybody starts going down the slide.
Right. Yeah, and that's the other thing people are looking towards is the Fed, pausing or cutting. As we both said, that's a misnomer, right? Because typically what that means is they're reacting to a recession if they're cutting as they're ramping rates up. If they go to ramping rates up and then suddenly the rate structure is an Eiffel Tower because they're quickly unwinding what they've done, that's in response to recession. And I think that's why they're trying to, as quickly as possible. I know they pause. They said it wasn't a skip because they intend to do all of the raises they plan to do, but it was a pause. I think they're just trying not to do, because this is the most aggressive rate raise. And so I think they were just thinking, if we pause this particular rate hike and resume it on the next one, at least, we'll give the market a little bit of breathing room. But I think they want to get to that point, Bob, because then they have, 5 percentage points that they can combat and ease as this market rolls over. And especially if we get into a recession, which if you've been listening to the way the Fed has been talking, and they don't talk outright because they know that the algos are, just act spastically to what they say, but they are basically opening the door for recession. They'll say, they go from not happening to unlikely to soft to shouldn't be too bad. And then, in a couple months, it'll be like, well, it might be moderate, but they're basically, because then they can go back and say, well, we didn't say it wasn't going to happen, right? But they do it gradually. They've always done. That's how they communicate with this market now, because they know it's so algo driven that they don't want this market getting crazy. And I mean, look at what happened in June already. I mean, it got way too overbought, and they didn't necessarily give the market a whole ton of dovishness to run with. That's just the nature of this market. It's very over leveraged, and they're trying to fight that and get these asset valuations down. So go. But at the same time, as we've seen last year off of August, it can get really dumpy and be a one-sided sell market too. So it's perfectly capable of doing that. So they're dealing with this very volatile nitroglycerin market, right? And they're trying to navigate it without, saying too much one way or the other. It's a challenge for them, but at the same time, this is what you get when you manage the liquidity of the markets the way that they have been. And, it started with Greenspan with his easy money policy. And now here we are all these decades later fighting this monster now.
Yeah, if you ever hear them say, well, like we told you, then you know they're rolling off back to the abyss. So look, they the only way that you're going to see deflation. See, I hate now saying, well, deflation's coming. Well, remember, deflation and rising and lowering costs are two different things. So
right.
In order for them to achieve, quote unquote, the deflation, the PC deflation, is that Janet Yellen's increasing the money supply by 5% a year. That means we're going to have some sort of quantitative tightening or bank losses of 5% a year to get to zero, guys. Okay. Yep. And that's going to be an utter disaster for the economy. So, they're better off by not letting the government raise more money through debt and deal with it that way. We're going to get the worst of both worlds. We're going to get higher debt and inflation into things that you have to live on. At the same time, you're going to go into recession. These people, they don't love you. That is for sure.
Yeah, I agree. All right, guys. Well, that's going to do it for this episode. Let us know your thoughts. Are you in the market to buy or are you in the market to sell? And are you waiting? Love to hear your thoughts and also, your parts of the country. Let us know what you're seeing as well. And we'll see you on the next episode. Please hit like and subscribe. And thanks for your views. Thanks, Bob. We'll see you guys on tomorrow's video. Take care.
Trade Genius.